Hello, I'm Eric Mancini, Director of Investment Research and Wealth Advisor for Traphagen CPAs and Wealth Advisors. And thanks for tuning in to the webcast. Today we're going to be looking at a new investment we made for many of our clients, and that's the Variant Alternative Income Fund, ticker symbol NICHX. So in more detail, the topics we're going to be looking at is what this fund is essentially a replacement for high quality bonds, treasuries, investment grade, some cash, and why we continue to look for ways to continue to trim those assets and why we're doing it. An overview of the fund itself and the allocation it has to different unique assets, a discussion of those assets within the fund. We'll look at historical returns, risk, volatility, and actual historical allocation over time within the fund, and then our outlook going forward. So, first, why we're going into this fund and why we've gone into many alternative funds over the past several years is really the decline in interest rates. So for many clients, risk is important, lower volatility is important, and traditionally that has been taken that part of the portfolio has been taken up by high quality bonds, treasury bonds, investment grade bonds. However, as you can see by this chart, over the last 40-year chart going back to the early 80s, if you bought a treasury bond in 1981, you would get a guaranteed 13% per year for the next 10 years. That has dropped steadily over the last 40 years, where now you'd get about 1.2%. And so if you buy a 10-year treasury bond today, you are locking in a 1.2% total return if you hold that to maturity. It could go up and down in the interim, but if you hold it to maturity, you're going to get 1.2%. That is less than, and to some degree, by some measures, significantly less than the current inflation rate and the future inflation rate. So you're locking in a negative return. So for us as money managers, any investment that you're basically locking in a negative real return or a return less than inflation for the long term doesn't really make sense. So where we can, we're looking to get out of high quality investment grade bonds, treasury bonds, short-term bills, cash, which is yielding next to nothing or very low rates, and then into these alternatives. It's not just with treasury bonds. This is a chart of high quality corporate bonds. So bonds maybe of Johnson & Johnson, Microsoft, companies like that, where back in 1997, so this is approximately a 15-year chart, or what is it, 25-year chart? 1997, you would get 7.5% from high quality corporate bonds. Now that has come down all the way to 2.2%. So, either way, you're looking at US Treasuries, you're looking at investment grade bonds, in aggregate, and if you hold some cash in there, between all these allocations, if you were to just hold these high quality assets, maybe you're looking at 1.5%, 1% return over the next 10 years, and that's just not going to cut it. So we continue to look for replacements. So one of the replacements we have found is this fund, the Variant Alternative Income Fund. And what this looks for is very unique, hard to access, unique opportunities that most investors, the vast majority of investors, do not have access to and do not have in their portfolios. But we, through a lot of research, through a lot of working with Variant, through a lot of due diligence, we were able to find the fund, dig into the fund, work with management, look at their managers, their sub-advisors underneath, and really dig into the assets. And we think this is a really nice opportunity to replace treasuries, cash, investment grade bonds. That's something still very low volatility, but returns significantly more, we think, in the future. So what this fund looks to do is invest differently. So it's looking for niche opportunities, underappreciated, under the radar assets that are not really served by banks. They want to be first mover or early mover in a lot of these things, and just really look for unique financing decisions, solutions wherever that can come from. So again, looking to look at different types of risk. So not stock market risk, not economic risk, not interest rate risk, different risks. minimize the correlation to the overall economic cycle. So even if we get another recession, a bear market, it wouldn't necessarily have much, if any, impact on this particular fund. And they are avoiding the use of leverage. We don't want to get higher returns just from the use of leverage. So this fund does not employ much, if any, leverage. And what is in the fund? So as of now, these are the approximate allocations of what's in here. I'm not going to go through each one of these categories, but again, in general, all these are, for the most part, hard to access, unique strategies that most investors do not have access to. There may be only a few experts in each one of these fields in managing these type things, and those managers are who the fund works with. And we dug down to that level in doing our research on the fund. And each one of these pieces has little to nothing to do with any one of the other pieces in here. So even if something were to not perform the way they wanted it within, say, litigation finance, it would have no impact on trade finance or transport finance or royalties. So that is really a large risk reducer. So to get into what a couple of these things are, on specialty finance, that's sort of a catch-all. It's opportunistic. It could be, many different types of facilities across many different industries. One large example within the fund now, and this started maybe about a year and a half ago, is with COVID, there was a need to import PPE or personal protection equipment from overseas to the US. There was a company that was producing the PPE in Southeast Asia, a company that wanted to receive it and distribute it in the US out of Southern California. And this fund managed and developed a financing solution to get that shipped across the Pacific and facilitate that transaction. And that is a position in the fund. And it's been a nice returner, a nice yielding position for the fund that continues currently. Hopefully, when COVID is largely behind us, that will alleviate the need possibly for that, but that's okay. They move on and they make another, another deal that makes sense. Litigation finance, that is making senior loans to law firms or individuals, and that's backed by future litigation claims. So we're providing them cash flow upfront. In exchange, we get obviously return of principal and interest on top of that in the future once the litigation is settled and that comes in. And the interest rates vary on all these things, but in general, on portfolio finance, litigation, specialty, royalties, the gross yields on these things could range really from anywhere from upper single digits to upper double digits in terms of gross interest rate, depending on the risk, the structure, the complication of it. And that's one of the reasons we like the fund. Portfolio finance is if there's private equity funds out there, other private credit funds out there that need liquidity, that need cash to make a deal happen, or for financing assets. We can provide that to them again for a high interest rate. And then finally, royalties. So it's paying upfront. We provide cash flow upfront, maybe for the owner of song rights or video rights or something like that. And then we get a stream back in the form of royalties over time from that. So these are all different types of thing within the fund. Again, nothing to do with one another. Largely, interest rates well above what you could find in even traditional high yield bonds, and low volatility. Nothing to do with one another. That's a pretty powerful combination. And then it's not a passive static fund. So it just doesn't say 10%, 20%, 30% to each one of these things. The managers of this fund will go to where there is opportunity. So this is a chart going back to 17 through now of the different percentages through time of where the fund was invested. And as you can see, different categories represented different percentages within the fund, and that was just based on opportunity. So if you look back here, in mid-18, there was a pretty large percentage towards portfolio finance. That has largely been now removed from the fund. Another example is if you look at lately, the past 6 months, a year, there's been a pretty large increase in transportation finance within the fund. That's the purple. And there was really none, 19 and prior. And then as opportunities fade and appear, that will impact this. And they're always trying to find that balance of, risk mitigation, but also the best returns. And then these are the historical net of fee returns and risk metrics for the fund since inception. And it was incepted in October of 2017. So we have a good amount of data. So on the left, it's a chart of risk going from lower volatility on the left side of the chart. So it starts off, a 0 would be cash essentially. And as you go to the right, it increases. And then on the vertical is the annualized return. So as you can see, this fund has had an average return of just a little bit over 8% since inception, with a 2% standard deviation. You don't really have to know exactly what that means, but in general, that level of volatility, which is what standard deviation means, has been materially less than even high quality corporate bonds of like Johnson & Johnson, Microsoft, those type of bonds. So less volatility than even those type of bonds, and much less than high yield. But at the same time, because takes a lot of work to get these deals done, it's complicated. These are unique assets. They're able to get higher returns than high yield. So, high yields average maybe 5.5%, 6% over this period, where NICHX has been able to return about 8%. And then each month, since the fund's been around, we have data for what each month's return has been with the fund. So as you can see, the thing that sticks out to me is, on a yearly basis where they had a full year of data, 2018 returned 7.3%, 2019, 12.2%, 2020, despite the recession and the pandemic, still just under 6%. And so far this year, already, just through July, it's up 8.4%. So I would certainly expect, no guarantee obviously, but I would certainly expect a double-digit return in 2021 is likely. And out of all these months, which there's 46 in here, only 2 were negative, and those were just modestly negative. And that was during the pandemic recession in March and April of last year, where in March it was down 0.5%, April was down 0.27%. Outside of that, every month was positive. And then, our outlook for the fund going forward. And in summary, we view this as a great replacement for Treasury bonds, cash, high quality corporates for most clients. There's no more volatility historically, even less so, especially now if interest rates were to go up, it would have a negative effect on all those type of bonds, no effect on this fund. And at the same time, if we're looking at a combination of investment grade bonds, cash, treasuries to maybe return 1.5%, if we could get 6, 7, 8% here, obviously that's a very large difference. And we certainly would make that trade-off. And that's sort of the second bullet point here summarized. The third and fourth bullet points are very important. So all the different assets, and you could look at it as maybe 10, 12 different asset types are within the fund. They have nothing to do with one another, even within the fund. So that's a large risk reduction measure. And then if you take the fund overall and then compare it to any other investment we have in the portfolio, no little correlation. That's a second level of risk reduction that this thing produces for the entire portfolio. So we really like that aspect a lot. And in terms of returns, nobody knows. We would think there'd be excess returns for a while here. There's only this fund and one other that just opened a couple months ago that does this type of investing in the US. So it's very tough to get into. Most people cannot get into it, so that will help not to depress returns and increase prices, which is a good thing. So we don't know if 8% is sustainable over the next 2, 3, 4 years. That might be a little high, which has been the historical rate. So we wouldn't be surprised if returns come down somewhat, 6%, 7%, something like that. But even at that level, obviously for an average return, we'd be pleased and much, much better than, of course, what it's replacing. And that's basically what I had today. I hope you learned something about this new investment. For most clients now do own this fund. But again, any other questions, any other follow-up, you can contact your Traphagen financial advisor or myself at eric@tfgllc.com with any questions. Thanks a lot. Take care.